Welcome to the YouTube channel for On Call Capital. My name is Bobby Jones, and I'm a retired CRNA turned apartment investor. If you've looked at all into real estate investing, it's likely you've run into the phrase, all real estate is local. And there's a reason for that saying. I don't think anyone would argue that the New York and Atlanta markets are similar to those in Sandusky or Santa Fe. Even though individual markets can be very different from each other, there's a way that investors can organize them into different pots, if you will. Cities are typically grouped into primary, secondary, and tertiary markets depending on varying factors. As I explained, just keep in mind that there's some fluidity here. Some markets like Miami or Philadelphia can be considered as either a primary or secondary market, depending on which article you might read. Sometimes a secondary market can act like a primary or vice versa. A tertiary market can turn into a secondary one in a decade if the economic drivers are strong enough to drive that population growth. This is more of a guide, is what I'm saying, than hard and fast rules. So let's talk about primary markets. These are also known as gateway markets. They're the centers of long established commerce and population. Think New York, Boston, DC, Chicago, LA, and San Francisco. They're generally areas of intense investment and competition between some of the top private equity funds, REITs, and investors in the world. Moving on to secondary markets, these can offer many of the same amenities as primary markets, but they tend to be more spread out than those primary markets are. Think of your Houstons, Raleigh, Atlanta, Kansas City, Seattle, and Salt Lake City. Still very large cities, but not necessarily, on par with, say New York or LA. Metropolitan populations in these areas typically range between 1 to 5 million people, and they typically are experiencing really booming populations and economies. So moving to tertiary markets, these are considered to be more of, let's say, emerging markets with steady but controlled job growth. They typically have populations under 1 million for those metropolitan areas with wildly differing combinations of economic drivers. So what does this all mean for you as an investor? Well, these markets all behave differently from one another in predictable ways. One way is to look at your cap rates. Investors start hand wringing when they see that cap rates are falling in primary markets. And all that means is that things are getting more expensive to buy, making it harder to make those great profits that you might have become accustomed to. But cap rates in primary markets typically lag those in high growth secondary and tertiary markets because it's more of a product of that intense competition between the bigger pocketed equity funds and foreign investors. According to real estate research firm CoStar, cap rates in primary markets have fallen to a range of 2 to 4%, down from peaks of 4 to 6% in recent years. Meanwhile, cap rates in high growth markets have held steady between 5 to 7% because those markets are largely ignored by institutional and foreign competition. So this means that primary markets are just different from high growth markets. Higher rents and cost of living are driving folks away from those primary markets, despite their deep pocketed investors. They go to those high growth secondary markets with the same amenities and a lower cost of living. This makes high growth areas less volatile in downturns and gives investors steady increases in commercial real estate rent rates as well. In fact, when you look at the top 10 cities for rent growth in 2019, there isn't a primary market in the bunch. And that's why, as an investor, you should take a look at private companies that are operating in those secondary and tertiary markets. They tend to have lower fees and overhead versus the big funds in those primary markets. Plus, they invest in these higher growth areas and are more nimble in their decision making and their ability to adjust to market changes. At On Call Capital, I want to help you reach your financial goals with strong and steady returns. It's important to choose the markets you invest your hard-earned dollars in carefully. And that's why I partner exclusively with private multifamily operators working in those high growth markets. That's how I provide investors with the best opportunities in multifamily investing. I hope that you got some value from today's topic. If you enjoyed this video, I hope you'll stick around by clicking subscribe. And also feel free to visit my website at www.oncallinvestments.com for more information about apartment investing. We'll see you on the next video.